my recording. I'm going to try to wrap up chapter 5 today. May go over just a little bit. If I do, what I'll do is probably stop. I will stop at normal time. I may record a supplement to cover any material that we didn't cover this session. So, I'll let you know if I'm going to do that or not. So let's jump right back in. Oh, and exams, I will have them with me. I'm planning to come in for tomorrow's class, so I'll have them prior to pre-practicum, and I'll hand them, you can see me in the theater area, and I'll hand them back. And then I'll plan to do a Zoom session for those of you that want to go over the exam. I will plan to do a Zoom session to do that rather than an in-person session, just for convenience and safeties given our circumstances. Okay, so jumping into the material for today. Let's see if that zooms up. Okay. Just in my video for the purpose of recording. Okay, so we left off, we had been working through looking at the revenue curve and the cost curve. And the thing to remember here is, the thing we were looking at was, where's the break-even point? So the break-even point is the point where total revenue is equal to total cost, because when to the left of the break-even point, the total cost curve is above the total revenue curve. And so total cost exceeds total revenue, right? That's what that means when the total cost curve is above the total revenue curve. We have some dollar amount, say right here, that is greater than our revenue. And so when cost is greater than revenue, then we have a loss. Out here, at say volume 2, we have total revenue is greater than total cost. This is cost 2 and revenue 2. Right? So that gap is profit, right? That's what we're talking about. So very often, as we plan for a business, and model a business, what we want to know is, what volume of service must we do, assuming we're a service organization? If we're a manufacturing organization, what quantity of materials or quantity of product must we produce such that we will make a profit? Well, the point at which we transition from making a loss to making a profit is called the break-even point. And so what we're trying to do, graphically, we can see that as being the point at which the total revenue curve crosses the total cost curve. I realize I'm using the phrase curve because these could be curved. In this case, they happen not to be. Sorry. Sorry, I'm going to be doing that a lot, I'm afraid. Okay, so the formula for total revenue, remember, is price times quantity. And the formula for total cost is fixed cost plus variable cost times quantity. Right. So the point here at break even is where the two lines are exactly equal. So that means total revenue is equal to total cost. So the break-even point is where total revenue equals total cost. Or you could say it a different way, where profit is equal to 0, right? Because when total revenue is equal to total cost, you get 0 profit. So you could say, so we have our basic profit function, profit equals total revenue minus total cost. We could kind of combine this and say 0 equals total revenue minus total cost, right? And that would tell us this is going to be the quantity, or break even is the quantity where profit is equal to 0. So remembering that total revenue is price times quantity, and total cost is fixed cost plus variable cost times quantity, we can kind of rearrange this. We can add this term, which is a negative, to both sides, so that we wind up with price times quantity equals fixed cost plus variable cost times quantity. And then we can isolate fixed cost by itself. And there'll be a reason for this in a moment. So I can subtract this term from both sides, and I would get fixed costs equals price times quantity minus variable cost times quantity. And you don't have to put these in parentheses, but you can. And then using simple algebra, I can pull quantity out, and I can say fixed cost equals price minus variable cost times quantity. All right, so I've done a bunch of manipulation. What I'm trying to get at is a relatively simple formula that allows me to calculate the quantity that I need to break even. So remember that fixed cost, right? That dotted line here, that fixed cost is going to be present regardless of what I do. And so this thing here is called the contribution margin, this term. It's called the contribution margin. And it is the amount of contribution, right? So price minus variable cost. These two things are directly related to quantity. That's why we're multiplying them by quantity, right? As total revenue goes up under fee for service as we add additional units of service. Variable cost goes up as we add additional units of service. So we combine these two things that both increase as we increase units of service. Fixed cost, however, does not increase, right? It stays constant as we increase units of service. And so in our example earlier, and we'll come back to this in a second, but in our example we did last time, we were talking about the lab, and the lab had revenue per test equal to 50 and variable cost per test equal to 10, I believe. Yes. So the contribution margin per test was equal to 50 minus 10, or 40. So for every test that our little lab did, they brought in $40 to cover their fixed cost, towards covering their fixed costs and generating profit. So let's do make this make sense, right? If we look at this, going back to this version of our formula, right? When profit is greater than zero, when total revenue is greater than total cost, right? So when total revenue is greater than total cost, profit is greater than zero. Let me do this over here. Profit is greater than zero when total revenue is greater than total cost. Profit equals zero when total revenue equals total cost, and profit is less than zero when total revenue is less than total cost. So that all kind of flows from this basic statement here. Okay. So break even again is useful to tell us kind of what the minimum we need to do is, and that's gonna tell us basically when we get down to here where fixed cost is equal to the contribution margin times the quantity. What we can then do is say, all right, so we have fixed cost equals price minus variable cost times quantity, right? We can isolate quantity by dividing through by price minus variable cost, or dividing through by the contribution margin. So fixed cost divided by price minus variable cost is equal to quantity. That's going to give us our break-even volume. Right. So, and then contribution margin, and this again is what we're going to refer to as contribution margin, which I'm going to abbreviate as CM. So let's do our, let's talk about our lab example, because that'll probably help make it clearer. Right, so we said the price for the lab was 50, the variable cost per unit was 10, and the fixed costs were 100,000. So we're going to set up our profit function. So remember, profit is equal to total revenue minus total cost. Total revenue is price times quantity minus fixed costs plus variable costs times quantity. So we have a P of 50, right? Price of 50 times quantity minus fixed costs of 100,000 plus variable costs of 10 times quantity. And if we want to get to break even, we're going to set profit equal to 0. So we can carry this negative term over to the left side, add 100,000 to add 100,000 plus 10Q to both sides. We get 50Q equals 100,000 plus 10Q. We subtract 10Q from both sides. We get 40Q equals 100,000. 40, as I said a minute ago, is the contribution margin. Excuse me. So I can divide through by 40, and I get Q is equal to 2,500. So for our lab, quantity is equal to 20, a break-even quantity. So break-even quantity is equal to 2,500. Now I could have, if I had this idea in mind, I could shortcut that, and I could say 100,000 divided by the contribution margin 40 gives me my quantity, which is basically what I did right here, right? 100,000 divided by 40 gives me my quantity, right? Quantity then is equal to 2,500. So if you can remember that, feel free. So it's fixed cost divided by contribution margin equals quantity. We'll give you the break even. We'll give you the break even quantity. I don't expect you to remember that. I don't hold that formula in my head. What I hold in my head is this basic relationship. Well, this basic relationship, right? And because I can always derive this from this. So to be honest with you, I wouldn't bother committing this to memory. I would commit this to memory, because if you can commit this to memory, you can get to this. But you want to remember that the break-even relationship is basically what we're trying to figure out is how much quantity we have to do to cover our fixed costs. Because if we can cover our fixed costs, we break even. All right. So with the lab example, what we're saying is for the lab, 2,500 would be the volume where the total cost curve crosses the total revenue curve. So if you're at 2,500, the lab would break even. Let's redraw that. So our lab had fixed costs of 100,000. It had variable costs of 10. Right, so its total cost starts at 100 and goes up by 10 for every additional test. Its total revenue curve is equal to 50Q, right? So it has a slope of 50. So what we said was its break-even volume was equal to 2,500. So if it does less than 2,500 tests, then it's going to make a loss. And if it does more than 2,500 tests, it's going to have a profit. So profit when volume is greater than break even, and loss when volume is less than break even, right? That's the basic idea here. For fee, and remember, this is for fee for service. So going back to our so going back to our basic formula for the lab here, right? Let's look at this for a moment. So the basic profit formula for our lab, profit is equal to 50Q minus 100,000 plus 10Q. If I have a volume of 10,000, then I can just plug and play, right? 50 times 10,000 minus 100,000 plus 10 times 10,000, right? It gives me 50 times 10,000 is 500,000 minus 100,000 plus 10 times 10,000 is 100,000. So minus 200,000, right? This adds up to 200,000, gives me a profit of 300,000. I could also consolidate and rearrange my terms so that I'm looking strictly at contribution margin. So if I took profit equals total revenue minus total cost, so price times quantity, minus fixed cost plus variable cost times quantity, I can distribute that negative so that I get PQ minus fixed cost minus variable cost times quantity, right? And then I could rearrange terms so that I get PQ minus VCQ, right? Minus fixed cost, and then I can pull the Q's out and I can get P minus VC Q, right? So price minus variable cost times Q equals fixed cost. Remember, this price minus variable cost is my contribution margin. So what I wind up getting is profit equals contribution margin times quantity minus fixed cost. So that's another way to think about it. Some folks would have you like try to memorize all these different variations on this same formula. All I'm doing is rearranging this, right? But you kind of want to have a sense of, all right, contribution, because some of your questions in your text are going to ask things about contribution margin. So basically profit is contribution margin times quantity minus fixed cost, because contribution margin is tied to quantity. So as quantity increases, my contribution margin keeps on going up. And when contribution margin times quantity is greater than fixed cost, then I'm going to have profit. But again, all I'm doing is manipulating. And again, I would really emphasize that you need to memorize this overall formula. You need to know this formula overall. What I will give you on the exam will be the basic statement: profit equals total revenue minus total cost. You're going to have to memorize all this part. But that's all you really have to memorize, because all these other things can be pulled and extracted from it. So the lab with 10,000 visits, we could plug in, we could use this formula for the lab. We could say, hey, profit equals contribution margin times quantity minus fixed cost. We know the contribution margin is 40, quantity is 10,000, fixed cost is 100,000. We get 40 times 10,000 is 400,000 minus 100,000 gives us a profit of 300,000, which is what we got a minute ago here, right? So that's just, again, because all I did was manipulate and substitute contribution margin for price minus variable cost. So I want you to be familiar with this idea of contribution margin because there's a theoretical value there. But in terms of like what to memorize this relationship, right? Or this relationship, either one. Again, that's just spreading the negative through. All right. What's the profit if the lab does 2,000 tests? Well, 2,000 is less than break even, so we know we're going to lose money. So at 2,000 tests, we have a contribution margin of 40 times 2,000, not 20,000, 2,000. We're going to try to keep saying it and keep writing 20,000 minus 100,000. 40 times 2,000 is 80,000 minus 100,000 gives us 80 minus 100 is minus 20,000. So at a volume of 2,000, the lab has a loss of $20,000. Sorry, blow my nose again. All right. So, so you can, once you have this formula, either this variation for the organization or this variation for the organization, this variation, right? Let's say profit for this organization is 50Q minus fixed cost plus variable costs, or you can have it as contribution margin times quantity minus fixed cost. Either one allows you to calculate the level of profit. And if your volume is greater than the break-even amount, you should expect to see a profit. If the volume is less than the break-even point, then you're going to see a loss. All right. So once we have this structure, once we have the formula for their profits, we can build what's called a P&L, a profit and loss statement. So profit and loss statement, or P&L. You'll hear this phrase P&L used a lot in business. This is not a healthcare thing. This is a business thing. And you'll hear it referenced very often or you'll hear the phrase used often to say, you know, the director has P&L responsibility. What that means is that a manager has responsibility for both profit and loss in her or his, come on. Why doesn't that want to focus? So that means that the manager has a degree of responsibility has responsibility for both cost as well as revenue, and it is kind of a statement of respect, right, within an organization. If you are a P&L holder or you have P&L responsibility, what we're really saying is you're a pretty important person, and you are being given responsibility to generate profit for the organization. So a P&L, really, if you can think about it, a P&L is just a income statement. It's really just an internal income statement, okay? So there's nothing magical about this. Now, the most P&Ls that I see in the real world look like little income statements. The way your book teaches it, well, it kind of shifts it around a little bit, but the way your book teaches it looks a little different than what I typically see. But we're going to go with the book just because I don't want to get things more confused. So the way we're going to write a P&L is pretty simple. It's going, and this is something you're going to need to, again, you're going to need to memorize this for the next exam. Okay, so you need to know this basic structure. The P&L has top line total revenue, then total variable cost, right? So total revenue minus total variable cost gives me total contribution margin. Then we subtract fixed costs to give us profit. This sort of follows the structure of the formula we did a minute ago. Where I'm taking revenue, price minus variable cost, so that gives me my contribution margin times quantity, so that's this top part, right, minus my fixed cost right here, gives me my profit. So that's what we're articulating with this statement. So total revenue is going to be price times quantity, total variable cost is going to be variable cost times quantity, contribution margin is going to be price minus variable cost times quantity. Fixed costs are what they are, right? That's the nature of fixed costs, and so then we just get profit. Okay. Why is this useful? Well, this is useful because we can start to run different scenarios for, say, our laboratory. And we can set up fairly quick comparison doing estimates of our volume. And I think maybe I'll do this in Excel. I'm doing pretty good. All right, let me see if I can get this going in Excel. All right. So we have our lab, right? And we're going to have a couple of variables here. We're going to build our little P&L. So our first item that we want to pay attention to is volume, then total revenue, total variable cost, right? That'll give us our total contribution margin, right? Fixed cost, and then profit, right? So this is, I've basically replicated what we've done a minute ago. And so we're going to take our break-even volume of 2,500. We said we already knew that. And I'm going to say, okay, total revenue is price times quantity. So I'm just going to program in equals, and I said I'll tell you what I'm going to do. I'm going to do over here price and variable cost per unit. So price is 50, variable cost per unit is 10. So I've got a volume of 2,500. So I'm going to take I'm just going to make this bigger. So my total revenue is my volume, right, or quantity, times my price. My price is 50 in this case. What I just did is, if you're on a Windows computer, you can hit the F4 button when you're working with a cell reference, and it will insert a $ before the column and a $ before the row number. And what that does is it locks the reference to the cell. Why do I want to do that? Well, if I copy this cell over to the right, which I'm going to do in a minute, it will adjust my reference D3 will go to E3 when I copy it to the right. The D will change to E3, but by locking the reference to C1, when I copy this over, the C1 reference will stay the same and the D3 will adjust to pay attention to the volume that I put here. So that'll make sense in a second. So at 2,500, my total revenue is 125,000. My total variable cost at 2,500 is 2,500 times my variable cost per unit of 10. And again, I'm going to hit the F4 button. I don't know what it is on a Mac, sorry. But on a Windows computer, you hit the F4 button and it automatically inserts those $. You can insert those $signs manually, just type them in. The same effect. Okay, so I've got, just make this prettier by adding commas. I've got total revenue of 125, variable cost of 25. My contribution margin is equal to my total revenue minus my variable costs of 100. My fixed costs are 100. And so my profit is my total contribution margin minus my fixed costs, right, or 0. Right? That line means 0. So I've just replicated for you what we've been doing manually, by writing this down. Now I can introduce a volume of 1,000, right? And we know that this is going to generate a loss because it's less than the break-even volume that we calculated earlier. So I'm just going to copy all these formulas over. And you can see what happened. Well, the references carried over, right? I said that I wanted to keep the constant reference to C1, $50 per. Nice. Hold on. Excel was trying to be helpful and counted down 1 for me. So you got to watch out. Excel does some of its own thinking sometimes, trying to be helpful. But my fixed costs stay 100, right? Regardless of my volume. So here, remember I said I put those $signs in, and what that did was when I copied the formula to the right, to the left, D3, which referred to the volume, became C3, which referred to the volume here, right? So I wanted it to do that, but I wanted it to stay referenced to the $50 per unit price. And then the same thing happened here, right? I did a hard reference to variable cost per unit, but copied it over to the left and got variable volume change, the C3 reference for volume changed. Okay. Contribution margin is still total revenue minus total cost. Fixed cost is still 100. And so at a volume of 1,000, we have a loss of $60,000. How about a volume of, say, 10,000, which is what we did a minute ago? We can just copy this to the right. Don't let Excel do that for me. And we can see 300,000. And we want to do it again. Let me see if I just do this. Maybe we'll do the, yeah. Those, if you see hashtags, that means that it's not wide enough. So you just widen the cell, There's nothing wrong. So we could do, now that we've got this Excel model built, we could say, well, what about 15,000? How's that do? And boom, it's all there. So that's, just a little bit of Excel practice. And then what if we did 20,000? And again, now it's saying that's not wide enough, so I just widened out. So I've got $1 million in revenue, and then 200,000 in variable cost, 800,000 contribution margin. Fixed cost is still fixed, and then we're at 70,000. Now, what did we say at the beginning of this chapter? We said, okay, we have fixed costs are fixed within a relevant range, and we said for the lab that the relevant range was up to 20,000. After which we would either have to hire an additional employee for an additional 50,000, or we would have to rent an additional machine for an additional 50,000. I think what we said was, we'll hire an additional employee and turn on a second shift. So to go to 20,001 lab tests, right? We can copy this over, except that this is no longer 100,000, right? It's now going to be 150,000 because we are having to add that second employee for an additional 50,000 in cost. And we get profit of 650,000, which makes sense. When we jump, we're only doing one more test, right? So we're going to have a lower profit than if we were really maximizing our fixed cost investments. So we go from 20,000 to 20,001 visits. We wind up losing almost 50,000 in profit, right? We increased our contribution margin by 40 because we did one more test for $50. We used $10 in variable costs, so our contribution margin was an additional $40, but we picked up an additional 50,000 in fixed costs. So this is useful. Excel is useful. I'll save this and put it on Canvas for you. I'll put this on Canvas for you a little later. All right, so I just want to demo that. It's a little faster for me to do it in Excel than it is for me to do it by hand. Easy enough. These are not hard calculations. But we can also, because with Excel we can do some estimates. How does our situation change if we change our revenue per test? So what if our revenue per test falls to $35 per test instead of $50 per test? What will that do first of all, to our break-even volume? Well, hopefully you can immediately see that if we cut our price from 50 to 35, you can kind of envision, well, we'll wind up with a contribution margin. Insert a line here. Our contribution margin per unit is equal to 50 minus 10 or 40. If I cut the price from 50 to 35, the contribution margin drops to 25, and we can see all of the results fed through our model, which is what's nice about Excel. And we can see that we no longer break even at 2,500, right? So if we change our assumptions from a revenue of 50 to a revenue of 35, we have to recalculate our break even. So coming back here, okay, so we say, all right, what is our new break even? Well, we need to set profit equal to 0. We say total revenue is now 35 times Q minus our fixed costs are still 100 and our variable costs are still 10. So we now have to solve a new for a new break even. I'm going to feed through the distribute the negative, and then I'll consolidate terms. So 35Q minus 10Q gives me 25Q, sorry, 25Q minus 100,000. 25Q equals 100,000. And we can see Q is now 4,000. 100,000 divided by 25 is going to be 4,000. So our break even went from 2,500 to 4,000 because our revenue per unit fell from 50 to 35. This matters because we're trying to figure out, we're going to want to know in the real world, we're going to want to know what the effects are when we're negotiating with an insurance company and the insurance company says, hey, you know what, we used to pay you 50, but now we're going to pay you 35. What's the impact on our business? Well, our business is going to, we're going to lose profit, right? We're going to lose, we're going to go from having a break even of 2,500 to a break even of 4,000. Which is what's been happening in healthcare for years now, is insurance companies keep putting pressure on healthcare organizations saying, and playing them off each other, saying, hey, hospital A will offer you, $100 per visit, or clinic A will offer you $100 per visit. Clinic B, can you do it for 95? Clinic B says, okay, we'll do it for 95. Come back to hospital A. Hey, clinic B will do it for 95. How about if you do it for 90, right? And so the insurance companies have been going back and forth. That's why we have that insurance companies set up networks, right? We've talked about this in various classes. They go about setting up networks, right, where they say hospital A is in our network and hospital B is not in our network, right? What they're doing is they're saying they're negotiating and getting a lower price from hospital A by playing hospital A off hospital B or clinic A off clinic B. And a narrow network means that the insurance company has really played hardball with the providers and has promised, maybe there's 5 or 10 providers in the market, and the insurance company has negotiated with all of them, and the lowest cost provider winds up winning the contract from the insurance company, and the other 9 of the 10 are left out. If you live in that community and you look around and you're like, there are 10 clinics in this community, but I can only go to 1, that's a very narrow network. 90% of the providers have been left out of your network, right? So when you go to look at your insurance and you're like, if I go to an in-network provider, right, one that the insurance company has negotiated a price with, then I pay one price. But if I go out of network, I'm going to have to pay a higher price. That's a common structure for insurance. All right, I'm going to keep driving on here. So there's kind of constant pressure to push down, and so as a manager, you're going to have to be able to calculate, all right, how low can I afford to go? How much lower can I reduce my price? And if I reduce my price, what must my volume increase to? All right. I'm going to skip that example. what if so let's look at let's go back to looking at our lab. Let's say we're currently at 10,000 visits. So this is where we're sitting. Our average cost, our average total cost is going to be equal to our total variable cost plus our fixed cost, right, divided by our quantity, 10,000. So our average cost to provide this service at 10,000 is 20. How low could we afford to go to sell services? Well, we could go as low as 20, right? And that would cover costs. Now we would be breaking even at a volume of 10,000. If we charge 20, we would exactly cover our costs. So, but what about, what if we were doing 10,000 and a new insurance company came to town and said to us, hey, we see you're pretty busy. You're currently doing a volume of 10,000. We would like to contract with you to, we are going to bring you, we could bring you, in addition to the 10,000 you're already getting, we could bring you an additional 2,000 beneficiaries. We could bring you an additional 2,000 beneficiaries. However, we only want to pay you $18 per test, not the $50 or, well, let's put that back to 50. Not the $50, well, that changes, yeah. Not the $50 you are currently charging, but $18. Do we take that deal? We're going to go from a volume of 10,000 to 12,000, but for the first 10,000 clients, we're going to get $50 per visit. For the next 2,000, we're only going to get a price of $20 per visit. So do we take that deal? I'll let you think about that for a second. Do you want to take that deal? I'm offering you, the offer is $18 per visit. At 10,000 visits, your average total cost is 20. Do we want to take that deal? Well, let's insert a column here. We need to be yellow. And let's think about it. So volume is going to go to 12,000, right? But our total revenue now is going to be kind of bifurcated. We're going to have, our total revenue is going to be 10,000 times $50 because our first 10,000 clients are going to pay $50 per visit. And then 2,000 clients are going to pay $18 per visit, per test. So our total revenue is going to be $536, right? That's based on 10,000 paying 50 and 2,000 paying 18. What's our total variable cost going to be? Well, our total variable cost, the variable cost doesn't change based on how much somebody is paying. So it's going to be 12,000 times 10. Right? So our total contribution margin is still going to be the same. Copy from over here. Right? It's still going to be 536 minus 120. So I've got a positive contribution margin of 416. Fixed costs are still 100,000 because I'm still in the relevant range. And so my profit is 416 minus 100, or 316. So I've actually seen profit go up, right? Even though my new price, the price for the additional visits, is below my average total cost, right? I still increase my profit. So what's going on here? Well, I am just spreading. I'm getting an additional 2,000 visits. I'm spreading my fixed costs over 12,000 visits instead of 10,000 visits. But the important thing is my contribution margin per unit. So let me stop share. Right. So the contribution margin per unit, in this case, the contribution margin per test at $50 is 50 minus 10 equals 40. At $18, it's 18 minus 10 equals 8. Right? Now, obviously, I'd rather have a contribution margin of 40 than a contribution margin of 8. But I can, if my contribution margin is greater than 0, right, then I want to take the additional volume. With an important caveat. If in the relevant range. Right, so the key here is by adding 2,000, I didn't trigger a need for additional fixed cost investment. Right, I was able to continue to use the fixed cost investment I already made. The one machine and the one lab tech, because I was able to. Right, I was able to. I was able to stay below 20,000. So I was already breaking even. That was the other piece that's important, is I'm already breaking even. So if I'm being offered additional workload at a lower price, as long as my contribution margin is positive, then I ought to take that additional workload, even if it's lower than my original price. Even if it's lower, even if the new price offered is lower than the average total cost. What I really care about, if I'm already breaking even and I'm not adding additional fixed cost, the rule that I'm going to apply is, will the new price per unit give me a positive contribution margin, or allow me to sustain a positive contribution margin? So how low of a price could I take for additional workload, going from 10,000 to 12,000? So I'm already breaking even, right? And going from 10 to 12 does not force me to take make additional fixed cost investments. How low could I go? What's my kind of decision point where I'm like, no, I'm not going to go any lower than that? What would I be?
11.
Yeah. Okay. So 11 would be 11. The point at which my contribution margin equals 0 is where my price equals my variable cost. So that would be 10, right? So I wouldn't take 10. I wouldn't go to 10. So if we're going to do whole numbers, the lowest I would go would be 11, right? Because if that's equal to 10, then I want a contribution margin greater than 0. So my price, let's say if we're going to go with whole numbers, would be 11, right? $10.01, let's say, would be, I would be willing to go, though I, probably wouldn't bother with a penny per unit. but I could go, let's say, as low as $11, right? Because 11 is greater than 10. So as long as contribution margin is greater than 0, right? And contribution margin is price minus variable cost. So when price equals variable cost, I don't want to do that. So I always want to have price be greater than variable cost. So as long as price is greater than variable cost, I'm going to have a contribution margin that's greater than 0. So I should go ahead and take that additional work. As long as I'm already breaking even and I don't have to make any more fixed costs. So most organizations have multiple payers, and what revenue actually looks like as it comes in is not a straight line. So let's say they've got some fixed cost, they've got their variable cost, right, for their total cost. They've got most clinics and other healthcare organizations have a mix of payers. They might have commercial payers that pay pretty well. They have Medicare that pays kind of mediocre. And then they have, let's say, Medicaid, which pays poorly, right? Well, if you have commercial payers, let's say, that get you up to here, right? And they have a pretty high payment per unit. So your commercial volume, this is volume. Your commercial volume, the number of commercial payers is up to here. Then you have Medicare. And hopefully what I'm making clear here is the slope of this line is greater than the slope of this line. This line is flatter than this one was. It's closer to my variable cost, right? So let's say this is 50. Let's say the variable cost is 10. This is, say, 25. And then Medicaid is, let's say, 12, right? They would make an argument. You'll hear organizations make arguments saying that they lose money on Medicaid patients. Right? You'll hear that a lot. You'll hear them say, well, we lose money on Medicaid patients. What they're really saying is the average total cost per unit, right, in a range, even out here, right? So in this range, right, at 12,000, the average total cost is $1,833. So what you would hear a clinic say, right, is, hey, you know what? Our total cost per visit is actually $1,833, and we're being paid $18. So we're really losing money for every visit that we do. But they're not really losing money for every visit that they do, because their variable cost is $10 per unit that they see, not $1,833. And so they have $8.33, $8 in contribution that they get to add on to covering their fixed costs and add to their profit. So now going back to our drawing here, as long as this is total revenue, as long as the revenue per unit is greater than the variable cost per unit, right, that's my variable cost per unit, as long as the slope of my revenue curve for each of these, so this was 50, 25, and 12, we said, as long as these are all greater than 10, then we should take that additional volume, right? So this is our Medicare volume, and then this would be our Medicaid volume, right? So why do if Medicaid compensates so low, right, lower than average total cost, why do healthcare organizations take Medicaid patients? Well, they're not their preference. They don't want Medicaid patients. But taking a Medicaid, my point I'm trying to drive home here is, if you've already covered if you've already made it to your break-even point, which is here, right? So you have covered your fixed costs. If you've already covered your fixed costs, then you may as well, and you don't have to take on any more fixed costs. Then the only thing you're worried about covering are your variable costs. So you can take on additional patients at lower prices, less than average total cost, as long as the revenue per unit is greater than the variable cost per unit. Right. Once you have covered your once you've gotten through break even, you can afford, you would want to continue to take additional workload as long as revenue per unit is greater than variable cost per unit, because in this case, contribution margin would be greater than 0. And so Medicaid gets away with such a low payment because what they're counting on is the higher paying patients, in particular the commercial payers, and even Medicare, which are both higher paying, will help the organization break even. And then Medicaid tries to be what is called the marginal cost, or the marginal cost payer, which basically means they only want to pay you what it costs to do one more visit. Well, what does it cost to do one more visit once you've broken even? Well, the cost in this case to do one more visit is the variable cost, which is 10. Right? So Medicaid tries to set pricing right at or just slightly more than the marginal cost, or the cost of doing one more. Marginal cost means the cost of doing one more unit. So one more visit or one more test in this case. Okay. All right. And this applies, I'm using a lab test, but this applies whether you are doing a clinic with an average revenue per visit and an average cost per visit, or whether you are doing lab tests or whatever. Right? The math is all the same. All right. I'm going to shift now for the last couple of minutes of the class to talk about capitation. So we talked about capitation before, and capitation, right? So far we've been talking about fee for service, where we get paid some amount of money for each unit that we do. We're going to now switch to capitation, where a provider agrees to a fixed revenue per patient, not per unit of service. So we're not going to do, we're no longer going to calculate a revenue per test, for example, Instead, we're going to calculate based on the number of covered lives. So the measure here, the measure is covered lives is the phrase we'll use. So how does revenue work under capitation? Well, the way it works is we come up with a per member per month charge called we abbreviate that PMPM. Okay, so the provider gets a per member per month charge, right? So total revenue is under capitation is PMPM times number of members. Okay, so number of members or number of covered lives. So if the member per month is, say, $50 and the number of members covered is 10,000, then the monthly total revenue is 50 times 10,000 or 500,000. Then to get the annual total revenue, so annual total revenue, you take PMPM times number of members times 12, right? So that would be 50 times 10,000 times 12 gives me 6 million. Okay, so that's how you calculate revenue. Notice that there's nothing in here about how many visits do these members do. So what we're signing a contract saying is, all right, organization, all right, health insurer, we'll provide services to your members, some fixed number of members, an unlimited number of services, right? Whatever services they need, we'll provide those services to your members for a fixed payment per member per month, right? So in this case, we're agreeing to provide some set of services to 10,000 members for a price of $50 per month. And if you wanted a per member per year, PMPY, you just take the per member per month times 12. Now, let's imagine it's a clinic, right? And that clinic has some amount of fixed cost. That would be the secretary salaries and the rent and all that kind of stuff. And then it has some amount of variable cost, right, at some rate, which is added onto the fixed cost to give us our total cost. So the cost side of managing under capitation looks exactly the same as under fee-for-service. However, what looks different is the total revenue, right? If I agree to $50 per member per month times, say, some number of members, say 10,000 members, right? I get a fixed number. It's 500,000. Right? It doesn't change with volume. So my revenue curve looks something like this. It's a horizontal line, kind of like my fixed cost, right? It doesn't change with volume. My break-even is still the same. Break-even volume is here, where total revenue crosses total cost. But and the relationships are the same in the sense that where total revenue is greater than total cost, we have a profit, and where total cost is greater than total revenue, we have a loss. So over here at volume 1, I have a profit because my total revenue at volume 1 is above my total cost. So here we have profit is the gap between total revenue and total cost. Over here at V2, I have a loss. Why do I have a loss? Because total cost, right, is above my total revenue at V2. So at break-even volume, right, I switch from having profit to loss. Well, that's the exact opposite of what we had before. Right? Before, we had a loss to the left of break-even volume and a profit to the right of break-even volume. Now we have profit to the left and loss to the right. And why is that? Well, we're getting a fixed payment, right? We're getting $500,000 whether we do 0 visits or 10,000 visits. And so, what capitation incentivizes providers to do is to do fewer visits, right? Because for every visit that the provider does, total cost goes up, but revenues stay constant. So as providers do more and more visits, their profit, that gap between total revenue and total cost, gets smaller and smaller and smaller the more visits they do. And to the right of break even, every visit they do past break even, they generate a greater and greater loss. So this here is a loss where total cost exceeds total revenue. So if we had for this one, if we have total revenue equal to 50 times 10,000 times 12, right, for 6 million, then we have there's no variation for volume, so that's going to always be the same. Total variable cost, let's say utilization, right? So let's say that there are $100,000 visits. Unfortunately, I'm making this up. 100,000 visits at a variable cost of $20 per visit, right? So this is variable cost per visit, per quantity. This is the number of visits. We wind up with 20 times 100,000 is 2 million in variable costs. Our total contribution margin is 6 million minus 2 million, 4 million, right? If our fixed costs are, say, 2 million, then the organization has a profit of 4 minus 2 for 2 million. What do we have to do? So here you have a kind of a mini P&L. What do we have to do to calculate break even for these guys? Well, it's the same thing. Profit equals total revenue minus total cost. However, total revenue is not price times quantity in this case. Total revenue is going to be this, right? Per member per month times the number of members times 12 months. PM times number of members times 12 minus, and then this is going to be the same, fixed cost plus variable cost times quantity. Right, so there's no quantity in the left side of this equation. For break even, we're going to set that equal to 0. So we have, if we know that this is 6 million, and we know that fixed costs are 2 million, and we know that, variable costs are 20 per visit. Well, now we can consolidate terms. I'm going to run out of space here, but we can consolidate terms, carry that negative through. So we get 6 million minus 2 million minus 20Q. So we know 6 million minus 2 million is 4 million, so 0 equals 4 million minus 20Q. And we could say 20Q equals 4 million. And then we could divide through by 20. What is that, 200,000? Yeah, 200,000. So we know our break-even quantity or break-even volume in this case would be 200,000. The difference, the chief difference here for doing break-even quantity calculation for capitation is the fact that total revenue is no longer driven by quantity. Total revenue is now driven by this fixed payment that we've agreed to from the insurance company. So doing the calculation for break-even volume under capitation is a little different. You have two fixed quantities. One more thing I want to do before we quit, in the last 2 minutes that I've got, is I want to jump back for a moment to our fee-for-service. So going back to fee-for-service, because it's a little easier to work with. So let's go back to our lab example where we had profit is equal to 50Q minus 100,000 plus 10Q, right? So this was PQ minus fixed cost plus variable cost times quantity, right? If I said, I don't get into business to break even. I get into business to make a profit. So if I want to make $100,000 in profit, what quantity do I have to have given this cost structure? Well, to calculate that, if I say I want a profit of 100,000, what's my quantity? I'm just going to take that 100,000 and plug it in here and say 100 equals 50Q minus 100,000. Excuse me. Plus 10Q. I made it most of the class without actually sneezing in your ear. Sorry about that. So now I'm just going to solve for 100,000 in this case. So I've got 100,000 equals 50Q minus 100,000 minus 10Q. So now I can consolidate terms. I'm going to add 100,000 to both sides, so I get 200,000 equals 50Q minus 10Q, so equals 40Q. Then I just divide through by 40 on both sides, and I get Q equals 5,000. So if I want to make a profit of 100,000, I would plug in. I would plug in the 100,000 profit target here, right, and then solve for Q. So that I think covers everything, all the core things in the chapter. The problems in the chapter go into a little more detail, and you'll do some stuff where you're manipulating. In particular, you're going to do some manipulation of using contribution margin, and there's some tricks with that. But the core lesson coming out of this chapter, if you can remember this formula for fee for service, and if you can remember this difference here for if you can remember this version of the formula for the profit formula for capitation, and this formula, this version of the formula for fee for service, that's 90% of the chapter, right? It's pretty straightforward. You just need to remember, and then you've got to remember, okay, if I'm going to go for some particular profit, I put that dollar amount in there. The only thing about calculating break even, is to remember that break even happens at zero profit. All right. So that is pretty much chapter 5. So go ahead and